Steve Major, if I told you that October would bring what October essentially brought to US equities, and then told you that the 30-year US Treasury yield would actually be higher on the month and not lower, what would you have said to me?
Normally, you would have expected lower US yields. That's what happened in February of this year, because we had the Hong Kong-China wobble back in February, and the S&P fell as well. Normally that's what happens. I guess there's a bit of a flushing out of risk parity type trades as well. So people who buy bonds as ballast in a portfolio against so-called risky assets, which include equities. I'm not here to make the call on the equity market, although I notice that most people in equities are quite happy to call bonds. But the point is, I think we're seeing a big shift in behavior away from risk seeking towards kind of loss aversion, and that favors the risk-free assets. I mean, frankly, you can't get anything on your bank account here. You'll get nothing, 10 basis points, but you can get 2% for 1 month on a bill. You can get 3% out on the 5-year part of the curve. So it seems to me that it's difficult to model this based on any kind of historical pattern, because this is new, and we've got risky assets very, very pumped up because of all the liquidity, and we're seeing central banks globally shift the impulse, and actually some quantitative tightening in some parts of the world, like in the US.
Steve, is it as simple as that? The end of the QE era, the start of QT?
It's probably one of the common denominators that I would want to include in the investment process, including the debt overhang. But don't forget, 10 years of QE have seen debt pick up in household and corporate sector, not just sovereign. And so we're talking about a shifting impulse on global QE, which includes China and the Eurozone, Japan, the US, at a time of excess debt. And hence, every 100 basis points of yield shift is worth much more today than it was 10, 20 years ago. And that's why I want to keep safe. And I know that at the moment the forecasts don't look that good on treasuries for us, because we were forecasting lower yields, but forecast isn't actually wrong until you get to the investment horizon.
So here's a question for you. A lot of people will be wondering where you think treasuries are going. I'm actually interested in where you think credit's going here.
Yeah.
Investment grade here in the United States. We actually started to see some cracks in high yield through October.
Yeah.
Are you worried about investment grade?
Yeah, very much. So high yield has seen positive performance through most of the year when investment grade was going down. In the US, that's unusual. I mean, high yield's supposed to outperform, but to have a hard form decoupling, positive returns on high yield, negative on investment grade, is quite interesting. In Europe, we wrote a nice paper. Dominic Keeney and S.J. Lee in our team wrote a nice paper on LBOs and the risk this imposes. A very late cycle type of behavior, all the M&A stuff. And the question is whether investors have looked at the clauses correctly, the covenants, and if there's change of control. When you get a company taking over and piling on a ton of debt, if you want to put the bonds back and they're yielding, the price is 120 and the put's at 100, you're going to lose a lot of money. So that's the point. It's late cycle, extra leverage coming in, and I think you're right to point this out. It's investment grade credit that we should worry about, not so much perhaps high yield. Bizarre, isn't it?